Hello, everyone. Welcome to the show. Which show? I don't know anymore. I really don't because how many shows have we done
I'm
this
really going to
week?
have to send you rum. At least if you're drunk, you'll have more fun. It may not come out better, but at least it'll be enjoyable.
It's the Making Sense show with Jeff Snider, Eurodollar University Enterprise. The Eurodollar is all about money in the shadows, and one of those things that is in the shadows is the Fed's actions with a repo, where they perform a repo, but now it's called a reverse repo. Anyways, it's definitely caught a lot of people's attention, especially because it reached a number, $500 billion, that was much bigger than what we saw in March of last year during an intense global financial crisis. Does that mean there's a global financial crisis coming around? What does it mean that the Fed is doing all these reverse repos? We're going to ask Jeff all about that. Jeff, have I introduced you as the head of global research at Alhambra Partners yet?
Not yet, but I think you've done it enough times that most people would associate me with that title. So I think that's probably good enough.
Here's a great way to introduce the show. Not what I just did. I should have just read this. Over the past few weeks and even days, RRP, reverse repo, use has soared to nearly 433 billion, and now it's $500 billion, right?
482 billion as of yesterday.
That's the highest in a very long time, and quite a bit more than during the last few weeks of March 2020. Everyone now wants to know why. Let's take a step back. Let's go back in time. Let's go back to 2008. How did this whole reverse repo thing come about?
Well, the reverse repo are temporary open market operations. So it's not like quantitative easing. It's sort of a program the Fed offers where banks can go to it if they want to. And in that way, it's mostly like the discount window, except it doesn't have to do with funding. You know, it's not that depository institutions are short of cash and need the Federal Reserve's bank reserves or some other form of cash to fund their positions. It's actually the opposite, which is why we call it reverse repo. Let's take a step back. You know, repurchase agreement is where is done from the perspective, or it's termed from the perspective of who is someone who is essentially a cash borrower. So in a repo, I'm borrowing funds from somebody else and posting collateral. So cash comes to me, collateral goes to you. That's a repo. A reverse repo, from my perspective, is the opposite. I'm the one now lending cash and receiving collateral. So a reverse repo, from my perspective with the Federal Reserve, means I am lending the Federal Reserve cash and receiving collateral, which I think already people are scratching their heads saying, what the hell is the central bank doing, borrowing cash from the banking system? And if you understand the purpose of the reverse repo in the Federal Reserve's monetary mechanism, it's really about trying to set a floor under interest rates. So if there's ever a situation where there are abundant reserves, for example, then you would need some kind of standing program to, quote unquote, soak up those reserves so that there aren't too much reserves in the marketplace depressing interest rates down to a level below where you want them to be as a central bank. So essentially, in monetary policy terms, the reverse repo is meant to put a floor under interest rates, which is why the Fed isn't really borrowing funds from the market. It's taking them out of the marketplace so they're not available to be used in other places.
And sending back collateral into the system, which you and I would be, I think, just generally in favor of. So that sounds like a good idea. But Jeff, why don't they just do it permanently? Why do they go through this whole reverse repo? Is it because legally it shows up as that there's no reduction to the balance sheet? Are they afraid of showing to the market that, hey, we're taking liquidity out of the system, so we're going to do it through this other fashion? Is that what you meant by when you say it's... Yeah, go ahead.
Go ahead. I was going to say, part of it has to do with the historical use. I mean, again, it goes back to, why do we call these things repurchase agreements? And we call them repurchase agreements because the title is not actually transfer. It's really a collateralized loan. But you got to understand, historically speaking, the Federal Reserve or a lot of central banks were never permitted to essentially finance what seems to be speculation. So in order to get around regulation where the Fed wasn't allowed to do business with, say, securities dealers and fund their securities dealing on a collateralized basis, they came up with a crafty way to circumvent regulation by calling it a purchase and a sale, or in other words, a sale today and a repurchase tomorrow. So it sounds like where the Fed is, which is allowed to buy and sell securities, but not to borrow and lend in them or with cash. And so really, that's really what has happened. It's the Fed is not supposed to actually lend on collateral, and therefore, because it's a repurchase agreement, the title doesn't actually transfer. So as far as the Federal Reserve's accounting goes on these reverse repo agreements, again, reverse repo from my perspective, which is I'm lending cash and getting collateral for my cash from the Federal Reserve, the Fed still wants to own those securities. So in a reverse repo, what you'll see is nothing changes on the Fed's asset side of the books. The securities in the SOMA portfolio remain there. Nothing happens. It's as if nothing is going on the asset side. Instead, it all takes place on the liability side. What happens there is the Fed debits the bank's reserve account and credits essentially this open market operation, which is an overnight reverse repo agreement.
The article that we're using as the basis of our discussion is titled Reserving Observations on the Reverse Repo of Reserves, posted on the 25th of May at Alhambra Investments. Jeff, you make it a point here to note that this is non-sterilized and non-standard policies back in 2008. And then you make a special note, you draw special attention to non-sterilized. Was our discussion just now an explanation of what you meant by non-sterilized?
No, what that meant was the relationship between the systemic level of reserves and emergency programs. Before Lehman Brothers, the Federal Reserve had done all sorts of auctions and things, TAF auctions and overseas dollar swaps in limited quantities, yet they sterilized those activities because they didn't want the systemic level of reserves to rise too much. Remember, in the early part of the financial crisis, the first financial crisis, central bankers, economists, mainstream media, they were all more afraid of inflation than they were fallout from this monetary panic. So the Fed, thinking that it needed to sterilize the level of bank reserves, kept them at a relative minimum. Again, that's why, why did they appeal to the reverse repo in September of 2008? Was one reason. This is a way to sterilize bank reserves. It's a way to soak up excess reserves so that they don't become inflationary. And again, that should already, you should be thinking, what the hell is going on here? We have a monetary panic, the worst one since the 1930s, and the Fed is more concerned about inflationary bank reserves. It just, it goes to show how just how off monetary policy is from reality. And this is one example of it, because as you just pointed out, Emil, from our perspective, we don't care really about the reserves part of it. We're more interested in what you said, which is collateral coming back into the marketplace. So yes, I have, from my perspective, it looks like I'm lending cash to the Federal Reserve, but I'm also getting something back. I'm not buying a security, but I'm getting security from the Fed in the form of pristine collateral that the Fed, since 2008, has locked up in abundance.
And so you don't feel that the original purpose of this program is particularly helpful or useful. But the use of the program does tell us something useful. It suggests to us that perhaps the system is constrained of collateral, that there's not enough collateral out there in the market, and participants, banks, are forced to go to the Federal Reserve. Here, this is how you put it. But in terms of the RRP itself, these repeated overnight auctions revealed something useful. If you are a cash lender who can't find a cash borrower with the financial collateral desire that you require, then the Fed's US Treasury collateralized operation markets for an emergency substitute in a collateral-constrained environment. I don't think I read that very well, Jeff, but I think you are saying there's enough collateral if we are willing to take not great collateral, but in certain moments we think we need the very best collateral, and there's not enough of it in the system.
If you're a cash lender like a money market fund, for example, who's a big part of the repo markets globally, and you've got cash to lend and you have to lend cash daily, And, some specific or non-specific morning, you wake up and try to lend your cash, but you can't find enough qualified borrowers for it. Borrowers who have the collateral that you need or you require to do these regular repo transactions. What are you going to do with your cash? Well, you're going to, first of all, what's going to happen is you're going to offer your cash at lower and lower rates to those who do have the quality collateral. So you see repo rates drop, GC rates, and then you see lots of special rates show up in the repo market, something we talked about before. And at some point you think, well, the rates of return on repo are getting so low because there isn't enough collateral in the marketplace. Maybe I'll consider lending cash to the Federal Reserve because I know the Fed has the collateral that I'm looking for. And so the usage in the RRP, where it's voluntary on the part of the marketplace, what that suggests is, or that indicates pretty strongly, is that maybe it's not a situation where there's too many bank reserves. It's a situation where those who have cash to lend can't find enough borrowers with the correct collateral, and they'd prefer to go through the rigmarole with the Federal Reserve to participate in its reverse repo, which pays right now, which pays a 0% interest rate. Think about it that way. You're more than willing to park cash at the Fed at 0% because you got no place else to put it.
Sometimes I wonder if I take too long during these episodes to get to the punchline, to the what's actually happening right now. But I like to set the context just in case people don't understand these things that we're discussing. So hopefully, dear audience, you don't mind that we go over some of the background details before we get to the meat of it, which is where we're going to right now, Jeff. The program is approaching $500 billion, and there are several theories out there why this might be happening. The mainstream orthodox theory is because there are too many reserves, so the system's got to soak them up. I'm going to pull up a graph.
In that case, the reverse repo is actually performing as it's designed, right? I mean, hey, this is great stuff. Good job, Fed.
Okay, yeah, and so I'm going to pull up a graph that shows what does it show? It shows reserves rising and the TGA falling, and seemingly that would suggest what, Jeff?
Yeah, what we're seeing is rising reserves. That's quantitative easing. That's permanent open market operations, which are intended to increase the level of systemic reserves. And you see them peaking in the middle of April, but that's simply just where the level of reverse repo started to really kick in. So for something happened in the middle of April, and what happens is, again, as I said before, here you can see it. The amount that goes into the reverse repo is deducted out of reserves, so it's not like the level of reserves are actually shrinking. They're just being shifted from systemic bank reserves, which is essentially a balance sheet remainder on the Federal Reserve's liability side, into this reverse repo account. So
yeah, we're looking at this graph. I suppose if we're not looking too closely, we're going to say reverse repo going up, reserves going up. Done. But if we look at it more closely, we see that the timing doesn't quite match up, does it?
Yeah, why the middle of April? That's really the question. Why was it the middle of, if you're thinking the issue is too many reserves, then what was the level of, it was just shy of $4 trillion in the middle of the week of April 14th. Why was that the magic trigger? And you can see how since then, the level of reverse repo is not commensurate with the increase in the level of bank reserves. So there's more going on in the reverse repo than just simply adding more bank reserves into the system.
So the system approached and hit 3.947 trillion reserves. And that is the magic number, Jeff. I don't know if you didn't get the memo, but we all agreed that once we get to that point, then there's too many reserves. No, this graph is perfect, Jeff, and we're going to go into it day by day practically, or week by week. And as you know, the reserves are actually less or stagnant or are unchanged during the period when the reverse repo program went parabolic. Okay, Jeff, buy me some time. I'm trying to look on this report here where we should turn to next. Where do you want to discuss next?
Go back
day
to
by
March.
day?
Let's go March 2020. Let's talk about that for a minute, because the reverse repo had a spike in usage in the second half of March of 2022, which again, makes sense with in regard to. I think I want to go down in the article, down a little bit further. There it is.
Yes.
Yeah, and so there you see too many reserves, right? The level of bank reserves goes up parabolically, and then cash-rich non-banks mostly had no place to put the funds, and so they parked them in the reverse repo, and that seems to be consistent with the idea that there are too many reserves. However, why did that spike only last until March 31st of 2020, and then in April, as the level of bank reserves only goes higher, much, much higher, suddenly the reverse repo was no longer an option, no longer an issue? What was the difference there? And I think the difference which explains it is that in the last half of March, as in the first half of March 2020, the system was hugely collateral constrained. And then along comes the CARES Act at the end of March, and then Treasury Department began selling Treasury bills at a furious pace toward the end of March, but really beginning in April. So all of a sudden in April of 2020, there's an enormous spike, an enormous surge, an accidental surge in the level of Treasury bills available collateral for the marketplace. And all of a sudden, nobody wants to use the reverse repo anymore, even though the level of bank reserves goes way, way, way up.
And now we're going to transition to your second article on this very topic, which you posted the very following day, and it's called No Reserving Interpretation About Reverse Repo Collateral Connections. And as you explained it to me, the first article is more of an educational background with a hint of what you might be concluding, something about the lack of Treasury bills collateral. And here we get into it much more day by day. And so we're going to be talking about Treasury bills. And in the front of the article here, you give a couple of reasons why they're very important. On the run, which we've talked about very often, and that they don't exhibit as much price risk. And
yes, just price insensitivity is a big factor too.
Can you give 1 minute just to remind people again the price risk of Treasury bills versus bonds, and just the on-the-run nature, just to remind people why bills are so important?
Well, the first thing with on-the-run is they're most liquid, which means they have a dependable marketplace behind them, which, again, in the repo market, that's all that cash lenders really care about, is if you default on the loan tomorrow, I can sell your asset at a dependable, predictable price. And what that also entails is that there's no price risk, right? Because even if there's a market tomorrow and something happens, the price might change overnight in between. And you don't want to be stuck with an asset that's falling tremendously in value that's going to fall more in value than the haircut that you have applied to protect yourself, or the over-collateralization you've applied to protect yourself. And obviously, long-term bonds are inherently risky in terms of inflation and growth expectations. So they have more of a, even in the short run, more of a price sensitivity that repo market counterparties have to take into account. Whereas Treasury bills, being of such short maturity, they're really only price risk during regimes where the Fed is changing short-term interest rates, which are well known ahead of time. So there's a very predictable price insensitivity to Treasury bills that doesn't always exhibit itself with Treasury bonds and notes.
We're going to pull up the graph we were just looking at, but now we're going to add a few dates to it. February 25th and 26th, March 18th, April 15th. Tell us a little bit why you highlighted these particular dates.
Well, March 25th, I hope, is something we've talked about before, and I hope people have paid attention to that, simply because that was FedWire, the big Treasury sell-off, all of that stuff that happened. And since that time, especially February 25th and 26th, we saw the global bond marketplace take a anti-reflationary turn, which is now 3 months long. Here we are on May 25th, talking about the same thing. We still go back to February 25th as if that has been an inflection point in the bond market's previous reflationary trading to now this anti-reflationary, or at least a reflation pause, which I think to me is inherently anti-reflationary too. So February 24th, 25th, and 26th shows up everywhere. And guess what? It shows up in the reverse repo as the first little really sizable blip where we start to say, what's going on here? Something has changed. And it doesn't appear to be too many reserves because, again, too many reserves are continuing to go much, much higher.
That's right. Reserves are climbing. Why the wiggle? Why the banana peel on the 25th and 26th because FedWire was offline for a couple of hours. It's just a banana peel, but if you're not paying attention, if you're fragile, that's, you're going to slip. And then what happened on March 18th? I note that on March 18th, Treasury Secretary Yellen started offering more bills to the market. And we also see here another blip, one that never reversed back down to zero. So it seems like, is the market saying we need even more bills?
Yeah, and I think that's really the point, is that before March 18th and a couple of days before, maybe the week and a half beforehand, that's when we saw bill yields really start to drop. They dropped more severely in January, but the second big decline in them happened during the early part and middle part of March. And you're right, Janet Yellen responded to that on the March 18th weekly schedule or bill auction schedule by raising the regular auctions. I'm not talking about the cash management bills, but the 4-week, the 8-week, and those, and the regular maturities like those. So Yellen obviously recognized, as she said, as the Treasury Department had said in their quarterly refunding statement, that they would monitor conditions in the bill market because they've been cutting back. And here we see, okay, bill yields fall, suddenly reverse repo begins to rise again, in addition to what had happened in March 25th and 26th.
And then you point out April 14th, April 15th. Is that because that's when we saw the reverse repo program take off like a rocket ship while reserves went flat?
Right, exactly. So what is it about April 14th or April 15th, that particular week, that would say, hey, this is where reverse repo usage is going to go parabolic? And it's really a continuation of those other things. So we connect all of these dots together. We have something happening on February 24th and 25th. We've noted it constantly in global bond yields. Even in TIPS markets, real yields have stopped being reflationary. We see it in Treasury bills, in particular middle of March. And then I think we get to what is the coup de grace, which is March 18th. Suddenly nominal Treasury yields, they join the rest of the global marketplace in anti-reflation at the same time that we've noted reverse repo usage going sky high. And so how do we reconcile all of these things where inflationary flood of too many reserves explains what's going on in reverse repo? We just can't. We can't reconcile them anyway with these market behaviors.
This is the key graph. So anyone that's not watching this on YouTube, if you're listening to the podcast, take a look at your podcast player at the time date, the timestamp, and check it out on YouTube at Alhambra Investments or on the Emil Kalinowski YouTube channel, and come and take a look at this graph. We're looking at long-term notes, 5 years and 10 years, and we can see those dates so clearly, the 25th and the 18th of March, February 25th, March 18th, and the inflection and the reverse repo taking off just perfectly. It's all right there, signifying basically that that's a good question, Jeff. Does this mean that the end of the world is imminent and guaranteed, as it usually is, or does it mean what?
Well, let's circle back to where we started this whole thing, talking about reverse repo and what it actually means in terms of collateral, and where I said usage can indicate collateral constraint. So we're not saying that all these participants who are flooding into the reverse repo program are causing this treasury market disruption that we're seeing in long-term treasury yields. No, what we're actually saying is that both of those things are a reaction to the same thing, which goes back to treasury bills, which is, as bill yields have fallen, treasury supply has been constricted. What these things are all telling us together is a system that is collateral scarce or collateral constrained. That's what's really going on here. And that's how we can reconcile not just treasury bill yield behavior, but the timing with the reverse repo, and also the reverse repo timing with longer term treasury yields, all of those things together, which are anti-reflationary, a collateral constrained environment, which would make perfect sense. And that's where we get all of these dots connected, is that what the system is telling us is that it's increasingly collateral scarce, which does not mean that this is the end of the world and June of 2021 is going to be a total disaster. It just means the system is in a much weaker, more fragile state because of it. And if there is some kind of spark or some kind of small thing, disruption, seemingly small, the butterfly flapping its wings in June, that could become a much bigger thing because the system is much, much weaker, given what's implied here about collateral conditions across all of these big things.
Systemic economic weakness. It won't be constrained to merely finance and capital markets. It'll spill over into the socio-political spheres as well. It'll affect us personally. And that's what we're going to talk about next in part 2. We're going to go to South America and talk about Chile, or Chile, depending if you can pronounce it properly. Stick around. We're going to see which one of us can pronounce that country's name properly.